Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Agostino. When it comes to real estate, today's guest has spent more than 10 years as a real estate investor and owns single-family, multifamily apartments and commercial properties with his investment partners. Currently, he is a principal at ApartmentVestors. That's a multifamily real estate investment company based out of Kansas. He's also the principal at Cullor Property Management. Our guest has also been a contributing author at BiggerPockets and Multifamily Insiders, where he discusses financial freedom through real estate, among many other things, of course. With all that, I'd like to welcome Spencer Cullor. Welcome, Spencer. Appreciate it.
Thank you. Thank you for having me.
So today I'd like for us to explore the world of real estate, especially as it relates to the acquisition and management of multifamily. I know you're really big on building cash flow, and I think it'd be great to get your thoughts on creating sustainable wealth. Since you closed millions of dollars in deals especially, there's probably many lessons to be learned.
There's always lessons to learn. I think if you're not learning, you're not doing enough.
That's right. Well, before we go on, I'd like to also point out to the listeners, if you like what Spencer has to say and you want to get in touch with him, you can reach him on Facebook or via his contact page at ApartmentVestors.com. You can also email him directly at Spencer@ApartmentVestors.com. I'll include the links in the show notes as well. So maybe Spencer, go ahead and tell the listeners about how you got started in real estate.
Yeah, well, it was kind of a waving around on how we got started in real estate. I was actually working a full-time job at a software company. I was in charge of our marketing to the healthcare sector, and I'd grown up in kind of small family-owned businesses and had a desire to really go out on my own. So I did it as a way, starting on the side of my regular job, to start to build a business that I could eventually leave my job on. Actually started by building single family spec homes and doing some fix and flips on single family. And I was working a full-time job, and then at night and on the weekends, I was general contracting homes that were being built. And that was quite a lot of work. We had at one time a couple framing crews going, and we were building, and this was before the market really crashed, and we did decent with those, but we saw the market start to slow down, and so we sold off our inventory in the single family homes before the market crashed, thankfully. But it put me back into my path that I thought I was going to be going to leave the corporate world. Didn't end up being where I thought it was going to be going. But one of the things that I really started to look into was different ways I could use real estate, because I was really sold on real estate, to provide an income and help. I was looking for real estate that could do well in up markets, down markets, real estate that could also provide income while you were operating project. So one of the challenges with spec homes is that you build it, and that may take 6 to 9 months to build, and the whole time you're putting out cash, and then at the end you're speculating that the price is going to be higher than what you built it for, and you get all your money back and make a profit. The problem with that is you have no cash flow to live on and things while you're building it. So you're just waiting, hoping that the market's going to be better. But a lot can happen in 6 to 9 months in the real estate world. And when you're not producing any cash flow, you can really put yourself in a bind. We saw a lot of developers and stuff around us go under when the market slowed down, because their inventory, they were having trouble selling it, had to take big discounts. Luckily, we got out before that, but it really made me think there's got to be a better way. And so I started looking for that, and actually ran into commercial real estate as kind of the answer for that.
Yes. Yeah, I think, commercial real estate is very different in that you're locking them in for longer periods, and these are businesses as well, right? I'm assuming.
They are. They operate 24/7. It is, I think a lot of people get into commercial real estate as a passive type of investment, but it's more of a business than a passive investment. unless you're one of our investors who, for them, it's very passive. But for us as the operator, it's definitely a very active type of business. But one of the things we loved about commercial real estate is that we could make money when we purchase the property. We could make a cash flow and monthly income every month while we owned it. And then we could really increase the value much greater than we could in single family homes to give us that nice appreciation and things on the back side as well. So to us, it had the benefit of the front side, during, and backside appreciation.
Nice. Now, when it comes to commercial, do you find that the quality of that business being in there plays a big role as far as liquidating that asset?
Yeah.
Which I'm not sure if you got into any of that stuff, but it sounds like you were just basically doing buy and hold, right?
We were. We actually started out with a retail investment, a small retail center. And man, no matter how much you think you know getting started, there's so much you don't know. And that's where it would have been nice to have more of a mentor when we got started to help us avoid some of the pitfalls. Commercial real estate, especially on the retail and office side, warehouse, works a lot different than on the single family home or even the multifamily side. And so much of the stability has to do with the quality of the tenants, the location, but there's so many things like, are you on the go to work side of the street or the come home side of the street? Is there a correct curb cut in the front or a signaled light? How much traffic counts? Just things we didn't understand. We more fell in love with the buildings than the location or some of the other things. And
yeah, I mean, it's those nuances that really make a difference, though, right? As far as even finding a tenant, it sounds like.
It is. One of the difference is one of the reasons we don't do retail and office anymore is tenants take so long. So in a multifamily property or even a single family home, you might have somebody move out. You can have somebody move in the next week or 2 weeks. It's really reasonable to replace them within a month. In retail and office, depending on your location and the size of tenant, it could take a year to replace that tenant. So you've got all that downtime in between. Not only that, that tenant may need the space to be completely different. So it'd be like knocking down all the walls in an apartment and building it back the way that tenant wanted it.
Yes. Yeah. Very expensive proposition.
It is. It's very expensive.
Yeah. Yeah. So I don't blame you for making that move to multifamily at all.
Yeah. It's definitely a much different world. It takes a lot more day-to-day operations. But to me, it's one of the best combinations of kind of your risk-adjusted returns with the amount you can do. What's great about multifamily is that small changes on an individual tenant basis can make huge differences when you go across a property of 10 or 100 or 250 units, which make huge changes in the value of the property.
That's right. That's right. And I know part of what you do is management. So I think that when you have those processes in place as well, and they're somewhat automated, it actually helps reduce overall costs, and it really also assists in delivering a better value to the tenants at large, right?
We feel so. We pretty strongly about that we try to do, the upgrades and the things that the tenants really want and improves their life, but also the things that they really are willing to pay for, which is important.
That's right. So maybe before we go into the property management side, we should probably take a step back and now maybe describe the decision that you made to get into multifamily in the first place. So you saw that doing the whole commercial thing was probably, time to move away from that and to go into single family or to go into multifamily rather. How did you pick that up? How did you define your underwriting and due diligence processes?
When I first started, I sought out people with more knowledge and experience than I did, sought out mentors. I also evaluated a ton of properties. So I went on LoopNet and some of the other websites out there, and I would just download property packages, and I would go through them and underwrite them and try to come up with what I thought they were worth. Even ones that were already sold, I'd come up with what I thought they'd worth. And then I'd find out from that broker what they actually sold for. And so it really helped me kind of define down what we were looking for in returns and how to underwrite them. I know I looked at probably 100 deals before we did the first one.
Yeah. I was going to say it's a common theme, right? Usually 100 deals and you analyze to one actually take down. Yeah.
Yeah. It takes a lot to really understand what you're doing, what is important in that investment opportunity, or what's important with that property. And we started to really define down what we were looking for. And now we've got a pretty specific criteria. When we go look at a property, we can save a lot of time by quickly knowing if we want to move forward or not, and if it's going to fit our criteria.
Yes. So that first deal, maybe we can go into that one. That one sounds interesting. So when you made that decision, and so you did all your analyses, you really dug deep, and you found something that was viable. Well, tell us about that one.
Sure. It was a small deal here in Kansas City. It was a little 40-unit apartment complex that had been owned by the same owner for about 25 years. And he had owned it. He was a doctor, and this was a side investment for him that he had totally paid off. He was ready to retire. I'd contacted him. He'd indicated that he was interested in selling. So we went and sat down, and he gave me his numbers. We went through them. And then I actually negotiated the deal, setting it as a kitchen table, which was a pretty interesting situation, and just he was super nice. But I remember somebody had told me in negotiations, you say what you want and just sit there and wait till they say something back. And I remember I was young and green, and I was sitting there at the table, and I'd made my offer, and I just sat there, and he and his partner were looking at each other. And after about a minute and a half, they finally just said, okay.
Nice.
It was so awkward and sitting there. I think they almost just agreed just to get somebody to say something.
Right. Nice. Excellent. That's great. So you took that deal over. Now, did you manage that one yourself? Did you have property management installed after you took it over?
Well, we didn't start off managing it. We started off with the property management company that we'd done interviews and gone through and met with several. We picked one. And within a couple months, they'd taken the property from about 90% occupied to about 70% occupied. And we were trying to understand what was going on, and we were having a hard time getting financial reports and information back from them, other than it was hard to lease. And this, it was just excuse after excuse. So finally, after about 3-4 months, we made a change to a different management company. They had the property for another 4 months. They did a little better right off the bat, and then they actually took it down a little further in occupancy, down to about 65%. At this point, I'm like, this doesn't make sense. If we're going to do this, I'm going to jump in and take over the management. It means a lot more to me. And that's really how my property management career got started, was jumping in to take over a property of ours that we felt very strongly about, but we were having a really hard time with third-party management on it. And within about 45 days, we had it to 100% occupancy. We'd raised the rents by, I think, $25 a month, and had a small waiting list on the property.
Nice. Excellent.
It was really hard to understand, what had changed, other than we cared a lot more, and we were more equipped to handle that size of property than a lot of property management companies are.
Yeah. Well, I think it's also what you said earlier too. It's nobody's going to care about that property like you will. There's that as well. Yeah.
I mean, property management fees are kind of set up in a strange way in how they're compensated. It's, a percentage of the rent taken in. But on most properties, you could have a $10,000 increase or decrease, and it may mean, a couple $100 to the property management company. It means $10,000 to you. So there's definitely much more incentive for you than there is for the management company in most situations.
Yes. So since then, now I think you manage way more properties at this point, right?
We do. We manage 7-8 properties right now that are in different stages. We kind of are total service provider. So we come in and help. One of our strategies is come in and do capital improvements on the property right when we take over to try to eliminate a lot of the big expenses, but also do things that we can really use to increase the value of the property. And then we manage it long term. So we kind of manage that whole process.
So that's a unique thing, because usually property managers don't really do that kind of stuff. They just, you hand them over the lease, you hand them the keys, and you walk away and let them and hope for the best. I think for the most part, the ones I've seen anyway, that's what they typically do. So yours is a little different. You're actually working with the owners up front to build in the value add right up front, it sounds like.
I mean, that's really kind of our specialty on that for sure.
Nice. Excellent.
Where I feel like we can add the most value.
Yes. Now you're still syndicating deals though too, right? On top of this?
We are. Yes.
So maybe before we go into some of those ones, maybe you can tell us a story about some tough deals that you've done. I'm sure you've had some doozies, and I'm sure that since then you've probably learned a lot of lessons from some of those mistakes. You might have even experienced yourself or seen other people do.
Sure. We've had some that we've walked away from after doing due diligence that, didn't meet our criteria after we went through all the inspections, which is a really hard thing to do because you've spent all that time and energy and money on inspections, but you have to be able to walk away on. We've done deals that were very difficult to turn around at the beginning, but have been some of our highest achievers since then. One of the deals we walked away from was about a 110 unit deal. It was a Class C type of deal. It was in a decent area. We were looking at coming in and purchasing it, doing some capital improvements. But one of the things we found while we were doing our due diligence is the financials didn't seem to match the bank statements very closely at all. And by going through very detailed, we figured out that the owner was overstating his income by over $100,000 per year.
Wow.
Which can make a gigantic difference in value. So we, took that back and addressed it with the seller. They never could really explain why that was, weren't willing to take a price reduction. And so we ended up walking away from that property. And it wasn't just that, but that was one of the things we found that pushed it over the edge of being from a good deal to a bad deal. But it also showed us kind of what the owner was willing to do to hide things. So when we did our detailed on-site inspections, we found lots and lots of things that had kind of been covered up along the way.
Yeah, well, you can't really trust them anymore, right? It's just like the level of they're not being authentic, and if they're blatantly covering things up, you can't even trust anything they say anymore at that point. It's very hard to even buy for someone like that.
But if we wouldn't have done that detailed of a due diligence, it could have cost us over $1 million in value.
Sure, easily.
Which would have been devastating to that deal and to our reputation with our investors. So doing key due diligence and detailed due diligence is extremely important.
Yes.
Another one that was very difficult, we had a smaller project that we did. It was a 72 unit deal. We started off, and just when we took over, just the issues we had with tenants to start were unbelievable. I remember on one of the buildings, it had 6 buildings. We had to evict all but 2 people in one whole building because they had all.
Wow. And hopefully not at the same time, right?
It was all at the same time.
Oh, boy.
Just to clear it out and start over. But we come in usually to challenging properties that have been maybe let go by the previous owner. They haven't kept on capital improvements, repairs. So a lot of times we'll walk into a project that's undervalued at the time and hasn't been taken care of. So we expect some of those problems. But when you're first getting started, it can be really overwhelming, especially if you haven't taken on that kind of project before, just dealing with really trying to verify who's actually living there versus what it says on the lease, who's actually paying, who's not, what kind of things you need to do. One of the things we do to make a property safer always is start off by working with the city, the police departments to come in and help us identify any problems and to help cleared out, because cities usually love us by the time we're done, because we've come into a property that's maybe a challenge and turn it around and make it one of the better properties in town. And they always appreciate that partnership that we kind of form with them on those. So there's always challenges and strange circumstances that come up on properties. Every time I say I've seen it all, there's something else that comes up.
That's right. But it's funny you should mention that one. There was a deal that I was looking at in Cleveland where it just looked like a fine deal. Looked like the building itself was in good shape. But interviewing the tenants, come to find out that later in the evening, when of course we're not there to perform our own due diligence of the property, through inspections and whatnot, there are, I guess some crowds of people that hang out outside and do all kinds of nasty things, So just like you said, though, I think by working with the police, working with local officials, they don't like that. They don't like to see that stuff either,
No.
So it helps in cleaning up that area. And yeah, of course, working with the city, though, that's a good piece of advice there. Absolutely. So, but as far as syndicating deals, what advice do you have in terms of raising capital? Because I'm sure at this point now in your career, you just do a call and it's somewhat easier to raise. But for a newbie investor, what advice would you give to someone just starting out?
Sure. One of the first things I'd have is have a clear business plan that you put together, a clear idea of exactly what you're going to be proposing to them, what kind of terms, what kind of returns you're going to be able to give them. You need to have a pretty clear business plan for your investment going into that meeting with the first investor or potential investor. If you're confident in it, they'll be confident in you. I think investors mostly invest with the person more than the project. I mean, sure, the project helps get them excited and everybody likes real estate and likes to see pretty buildings. But at the end of the day, they invest in people that they like and trust and that they believe they're going to get their money back from when they give it to, and that the people are going to do what they say they're going to do. So
yes,
I think there's just a lot of swindlers out there. And so I think being authentic and trustworthy and always doing what you said you're going to do are really big when it comes to raising money with investors.
Yes, absolutely. I mean, I think that, just like you said, having that mindset, having a positive mindset, having excitement around the business, having that integrity and really be able to get that across to an investor is huge. It's huge. Absolutely.
Everybody thinks that they have to offer these gigantic returns. At the end of the day, you don't want people that are looking for just returns, or they'll leave you for somebody that offers 1% higher. And that's not really the best way to build a business, I don't believe. You've got to have people that, when we talk to our investors, most of them want a fair return for their money. They want to put it in a project they believe in with people they believe in.
Yeah, absolutely. Totally agree. And I think at this point, now, are you doing investment funds, that kind of thing? Or are you still raising money in the syndication manner?
We've done both. So we'll either do it for a single property, which I think is the easiest way to start out, because then you can really make the presentation about the property and how awesome it is and what you're going to do on it, which I think is easier for new people raising money when you can kind of make it about the project, especially if you haven't done 10 projects before, you can make it about the one you've got pulled together. But we just did one of our first funds where it was a 3-property portfolio, and that went really well for us and our investors. But it's a little more complicated when you start putting that together.
Yes, absolutely. And just for the listeners, an investment fund is basically, think of it as an account that's set up in advance of actually finding a deal. So you're going off speaking to investors. You might convey a certain return based on a certain amount, and they subscribe, they put the money in the account, and at that point you're off now trying to find a deal to put that money in. The good thing about it is you have that money available.
Yes.
But the bad thing is you got to find a deal quick. or at least within a time.
Yes, they don't want you to hold it forever. Yes.
Exactly. So, because that's money just sitting around not doing anything, and it's definitely something that you want to be able to deliver a good return on, because that time counts, even if it's just sitting there.
It does. Yeah, and we usually, if we can't find a deal within a certain amount of time, we would give them back their money.
Yeah.
But you kind of got to walk that fun line, because you want to find the best deal. You don't want to have to jump on any deal. And we've been really good about, when we come to our investors, they know it's a good deal, because we try to cherry pick and only bring them the best deals. You just don't want to be in a position where that time's running out and you're forced to take a marginal deal.
That's right. I think part of it has to do a lot with developing those broker relationships and getting the regular flow coming into the office, on a daily basis, even performing the analysis, kicking out the bad ones and keeping your eyes on the good ones. In order to do that, though, you really need to have that process up front before you can even have an investment fund to back it up. That's what it seems to me anyway.
Yes. Yeah, I agree.
Yeah, absolutely. So since you spent your time doing the single family thing, you did the commercial thing, did the multifamily thing. So what do you think your outlook is for the next 3 years as far as the economic impact is concerned? I know that people are expecting things to go south in the next few years. You've seen it all already, and you've been involved with these various asset classes, which is usually an indicator. What are your thoughts? What are you seeing?
Well, we believe strongly in the multifamily market moving forward. We look at it as kind of that safe haven. And that's one of the things we looked at when we were first evaluating where we wanted to build our business, was around multifamily, because it's strong in real good economic markets, and it's also a place that people need and want no matter what the market is outside. Now, I think you might invest a little differently in that market depending on what's going on around you. I know we're looking for deals that have strong positive cash flow in them so that we can weather the storm between an up or down market.
Yeah.
And I think where you can really get in trouble is more if you're buying very marginal properties with very marginal returns without any way to add value to them. You don't want to overprice the market.
Yes. What's marginal? Like you're saying, like trying to get into a war zone or a C minus, or are you talking like going too high into an A plus?
Yeah. I mean, I think the better market you're in, the better. The better asset class you're in, the better. So, but we try to stay in that C plus to B plus market. We don't really want to be in the A market, and we don't really want to be in the D market.
Yeah, absolutely. Yeah, I totally agree.
So we like to be in the market when things are going well. People will go up from a C-class property to our property. If things are going bad, people are coming down from the A-class property to ours. We want to be kind of insulated in the middle.
Yes. And those deals are hard to find these days. I think everybody's attacking those B-class. Absolutely.
They are. You either have to take a C-class and do big upgrades to them, or you have to really find the right deal.
Yeah, that's right. And you're active.
But especially when the market's at the peaks, you got to be really careful, and you got to buy for cash flow.
That's right. And you're active in multiple states from what I saw, right?
We are, yes.
Excellent. Great.
We're currently in 3 states, but we plan to expand further in the future. So.
Good stuff. Okay, well, let's move into the mogul round. So this is where we really get a deeper sense as to your mindset and what we think, or what you think rather, is going to take to be successful in the real estate world. So are you ready?
Mm-hmm.
All right, very good. All right, so if you can give your 20-year-old self a word of advice, what would you say to them?
And I would have them start off and go work for a property management company, a bigger company that does property management. Learn those. If they really wanted to get into multifamily or real estate investing, I'd have them do that. Learn the management side and learn the systems.
You would have avoided tech altogether, you think?
I mean, I like tech. It depends what their interests are. But if their interest is in real estate, that's where I'd have them start.
Yeah. Great. What are your 3 most influential books and why?
One of my first favorites was The Magic of Thinking Big. I think it just opens up your eyes to what's possible out there and kind of get you to expand your vision. One of the other books that I really liked was, I think it's called One Thing. And it's really about how multitasking is really difficult, but focus on really the most important aspects of your business, which sometimes you have to leave some of the other stuff behind. I think those are two of my favorites.
Yes.
Can't be great at everything.
That's right. Absolutely. So to you, what's your secret ingredient for achieving success in this whole real estate game that we play?
Sure. I don't know if there is a secret ingredient. I think it's working hard and staying consistent. So every day trying to make improvements to your business. I think the other thing that's been really important to us is once we picked multifamily, we put on blinders. So we put on blinders to every other real estate opportunity out there, every other sector, and we just wanted to be the best in our lane. And I think that's been really important for us in our growth.
Yes. I think the importance of focus is key. I think many people just forget about that. They oftentimes at our events,
especially if you go to your local real estate investment group, there every week it's a different way to do this or that. And I feel like everybody's chasing the shinier object, the easier way to make more money.
Yeah.
I don't know that any of it's easy. You just work hard and pick your specialty. It's hard to do well unless you're great at a certain area.
Exactly. I mean, there's guys that do the multifamily, then they go into self-storage, and then they go into mobile homes, and then they go into land. It's very hard to be great at all of it all at the same time.
It is. It is.
Yeah. Excellent. Okay. Well, if any of the listeners, if you want to reach out to Spencer, if you like what he has to say, again, you can get him at Spencer@ApartmentVestors.com. So much value in this discussion. I really appreciate your time, Spencer. Thank you so much.
You're very welcome, and be happy if anybody reached out to us to help them.
Awesome. All right. Thanks.
Thank you.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.